Kevin here, top 100 financial advisor, two-time author, one-time bestseller, and we are here to talk about the stock market. For the most part, it was a quiet day, no real interesting news, but there will be some news definitely tomorrow and over the next, I would say, about 14 to 15 days, basically for the next 2 weeks. There are a string of IPOs, initial public offerings, that are going to hit the market, and usually investors clamor for this type of stuff, and things start to get a little bit crazy. And we know the reason why is because it's the first time that you get to invest in what most people hope and think is going to be the next big thing. Imagine investing in Facebook at $38 a share or $18 a share, and now it's at like $270. Same thing with an Apple, same thing with an Amazon, so on and so forth. So this is your time to get in on the ground floor. However, IPOs do have risks. They don't go up in a straight line. Not all of them are great, and we've talked about this before. So I want to talk about which IPOs are coming out, which ones I like, and I put that in air quotes because they're still risky. And I'll tell you how I'm going to manage it and if I even do it anyway. And as you guys know, I generally don't invest in IPOs at all. I'm like, look, you need to give me 10 years of history, kind of like, date or whatever. I need to know, like, are you normal? Well, we can't get married on day one. I need to know like how we really are in real life before I decide to do that. So that's what I need to know about the vast majority of stocks. But I do have one asterisk with one company that I still don't know, but we're going to discuss that. All right. So as you see, this is CNBC, lots of IPOs hitting the market, why you should invest with caution. And I am really, really stressing the caution part of this because I don't want you to jump into any of these brand new stocks. Number one, if you don't have experience. Number two, if you think that this is going to be a lotto ticket and a quick way to get money. It may not be that way. Zoom was like this. Beyond Meat was like this. Pinterest, not so much. Slack, not so much. So it can really go either way. Snapchat, Twitter, neither of those were great. Not even Facebook was great when it first started, and they actually cited that here. So apparently there have been 113 IPOs this year. Didn't know that. Apparently there are a bunch of companies that nobody really cares about because I haven't really heard of anything interesting. And this is probably going to be what they say is probably the most anticipated week or season since 2014, and it's definitely the busiest week since we've seen since last year in May of 2019 when Uber went public, which did not go well for most people. So again, if you do it, you need to be very, very careful before you jump into anything like this. I normally say, look, just wait and see how things go. But here's why. Generally, the way that IPOs work is, let's say I own a company and I build it up from the ground up. I fund it with my own money. I go ask big time investors. I don't know, Jay-Z, Beyonce, hey, invest in my company. And I have all their money. We're growing the company. Everything's great. But when we decide that we really want to grow and we need billions and billions and billions of dollars, we say we want to go public. We want to have what's called an IPO. Well, the Jay-Z's and Beyonce's that got with me in the very, very beginning, they get shares too, but they have what's called, in most cases, a lockup period, which means that they will get, let's say the stock starts off at $80 a share, they will get that. So they, I don't know, $8 billion or whatever, but they cannot sell those shares for at least 6 months in some cases. Sometimes it's 3 months, sometimes it's longer, but it's called lockup period, which is why after lockup period, people like Jay-Z and Beyonce who got in really, really early, they sell. They're like, look, I got in, I gave you $100,000. I got $8 billion. I'm good. I'm selling my shares. And those are usually a lot of very rich people, and including like the Goldman Sachs of the world, JP Morgan's, all these investment banks. That's when they tend to get out. And when you see a lot of money moving out, that's where you see a lot of these stocks fall. If you notice and you study IPOs, you'll see that a lot of them start to fall after that 3 to 6 month period. Now you could say, well, I'll wait 3-6 months, the stock will drop, I'm gonna jump in then. Well, that sounds great if you think you can time the market, which isn't the most reliable strategy because again, Snapchat, Twitter, still not doing great, still falling. Still ain't great. So just because you want to sit around and wait doesn't necessarily make it the best time to jump in either. It really depends. Zoom didn't really fall off like that. It just kept going up and ain't stopped yet. So again, it's very difficult to try and gauge. All right, so we talked about the lockup period. I want to go into some of these, and I think we have brought up Facebook before, but I want to highlight it here. So for example, again, Facebook close to $300 a share right now, but when it came out 8 years ago in May, it started off at $38 a share. By September, 4 months later, it was down to $18 a share. That is a significant loss, especially if you got in at what you thought was a ground floor. You got in early, you put your money in, however much you put in, you thought, oh, I got Facebook. I got a great company. It's not going to go anywhere. They're making money, blah, 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 blah. And then you turn around 4 months later and you're down to $18 a share. You would be very, very upset. And Facebook did not get past that IPO amount of $38 a share until like a year later. And you would have had to keep it 8 years until today to where you're getting to the $270 mark. Not everybody is built for that. Not everybody is built to say, look, I'm doing this for the next 5 to 8 years for this to pay off. Again, we never know. We know Facebook is here now, but also if you thought Facebook was going to be great, you probably thought Twitter was going to be good too. And you probably thought Snapchat was going to be good. And you probably thought Pinterest was going to be good. Only one of those has survived, at least till this point. Only one, and that one just happens to be Facebook. That's what makes it so difficult to pick and choose which IPOs to go for, if you should go for any at all. So again, flashing warning signs, if you do it, be very careful and know what you're getting into. And when I say you know what you're getting into, meaning you don't know what you're getting into, and just be ready for whatever may happen. It could be the best thing ever and pop and you make some crazy percentage. Beyond Meat did this, or it could just be awful. Uber did this. So just throwing it out there. All right. So one thing that you can do, which we also did, which is kind of funny. So one, Douglas Bonaparte, I actually met him. He's a very good advisor outside of the New York City area. So shout out to him. But also he dug up and suggested you should look at the SEC filing, the S1. That is the video that we did when I talked about Snowflake, 2 or 3 videos ago, and I showed you what the risks were. That was the S1. That's why you do it. It gives you all the risk and things that you need to know about the company. For Snowflake specifically, and we'll get into others, we know that they are losing money. That gap in losses is narrowing. We know that they've got Warren Buffett put some money in. We know that they got Salesforce that put some money in. We also know they're competing against Amazon and Microsoft. Those are 2 people I don't want to compete with when it comes to really anything, because they are savage. Those are 2 very tough competitors in the tech space. And we also know, as they noted in that S1, that they actually rely on Amazon to do some of their products and services, which is an issue. Just like the same way I rely on Facebook to get these videos to you, I rely on YouTube to get these videos to you. If they ever decide to not like me, I'm in trouble. I need to figure out what to do, because all my stuff is on Facebook, Instagram, and YouTube. I would be in serious trouble in trying to get this stuff out if I'm relying on them and I start competing with them. Now, I don't have to worry about that because I'm just a small guy and I'm not in that social media space in the way that they, like YouTube is. But Snowflake is, and I don't know if Amazon would ever retaliate and what that would look like. Again, I don't know. That is something that is a risk. I'm just throwing it out there. That is a risk. So again, you need to be aware of those risks and know what could happen. The best way, if you're going to do it, and I put a huge if on this, y'all know my 5% rule that you shouldn't put any more than 5% of your overall money into one single stock. With an IPO, you might want to reduce that and just say, look, 1 to 2% at most in a single stock. This does not apply to index funds. You put as much as you can in index funds. That's probably the best thing for you to do. But for an IPO, the higher the risk, the less you want to put into it. Because look, if you put money into an IPO, it doesn't work out, it's 1% of your money. You should have 99% of your money in other places that you know are working well for you. So that's if you're going to do it. Again, I'm putting a huge warning sign and caution that it does not work for everybody, and it may not work for years. You can invest in it, it drops, and you sell out. It can be one of y'all that invest in it and hold it for 5 years, and then boom, you're good. It really depends. All right, so let's go to talk about what some of these IPOs are. We may break down a little, do like one-on-one breakdowns for some of these. We already did one for Snowflake. There was a graphic here. All right, so we've got Snowflake. That's the one I'm excited to watch and cover and see what happens there. It's in the tech space. It's in cloud computing. my master's is in not cloud computing, but technology business. So I'm just interested to see where they go. The Warren Buffett thing really caught my eye. The Salesforce thing caught my eye. We've talked about that before. Never heard of Unity, JFrog, or Sumo Logic. I don't know who Amwell is. I do know who GoodRx is, and that could be interesting. The reason I say interesting is because it's in the health space. We know that tech stocks and health stocks tend to do well in times like this, where we're all concerned about health and everybody loves technology, at least right now. So again, don't know where it's going to go. I have not looked into their S1. I don't know if they're profitable. I know I've heard the name. I know it's health related. That's it. So maybe we can do a video and talk a little bit more about what we think may happen and what you may or may not need to know about it. We'll see. Plantier, don't know what they do. Asana. Now I've heard of Asana. They are a project planning platform. They're pretty cool. Is it enough to make a stock out of it and for me to put money into it? At least not right now. We'll see where it goes, but they actually have some little tidbits here. So for GoodRx, at a time when people are paying close attention to their health and their bank accounts, GoodRx seems like a winner. Again, although it all depends on the price. You don't want to buy something that's too high. So Kramer, I'm assuming this is Jim Cramer from CNBC is saying this. Maybe it's Tyler Clifford. I don't know. Maybe it's Jim Cramer. We don't know. Anyway, the point is, yeah, you can buy it. Yes, it'll probably be good, but do you want to pay too much for it? That's the thing that you have to worry about with all these. And it's very difficult to say what's too much to pay for something. A lot of us thought that Amazon at $3,000 a share was way too much to pay for it. Well, now it's at 31, 32, 33, wherever it is today. So there you go. I thought that Amazon at $2,000 a share was too much to pay for Amazon. We'll look at it now. So I really don't like that phrase. It's accurate that you don't want to pay too much, but what is too much 10 years from now? What is too much 2 days from now? You never actually know. So there's that. So that's GoodRx. Asana, they're doing a direct listing. We can talk a little bit more about what that means. But a direct listing, they've got a terrific growth rate, which is great. They're growing at 82% over their last fiscal year, which is their financial year, which is good. But they've also been a consistent money loser. I think it could be a good test case for what the market values. I don't tend to like companies that tend to lose money. It's one of the reasons I didn't do Lyft and Uber. They were losing billions with a B, which I assume they're probably still going to lose billions with more Bs. So again, I haven't looked into Asana. I need to look into it more to really see where I think they fit, but I'm not super high on them. If anything, y'all know I'm going to look very heavily into Snowflake. They IPO tomorrow on the 16th. We'll see how that goes. I expect it to take off, but again, you don't know. Very, very difficult. And then GoodRx, I don't know their IPO date. I am interested to see where they will go. This is probably, and I'm saying probably because we don't know what's going to happen tomorrow. We'll probably talk about Snowflake tomorrow since I'm pretty sure it'll be like the most dominant news story. But GoodRx is going to be the next thing on my list to look into. We'll see. So they've got the other ones here. Again, I don't know what they do. This one, Amwell, Given Teledocs, and Livongo's Digital Health. So this is digital health. Interesting, but also says still far from profitable. And then you got Sumo Logic. Even he is not familiar with that one. So there you go. But that doesn't mean just because you're not familiar with it doesn't make it terrible. There are clearly there are 113 IPOs out there that happened between now and the beginning of this year, and we ain't talked about none of them because I didn't know about none of them. So we'll definitely see. All right, so that is it for me. Before we go, thank you guys for showing up and supporting the video I did with Business Insider. That was very fun. If you got to see it, you got to see my son and everything. That was great and fun. Also, make sure you check out the Investors Toolkit because a lot of the things that you're going to need to decipher what stocks to invest in and which ones to avoid, as well as opening up your own account and building generational wealth for yourself. You want to make sure that you click the link above to do that. There's also a discount code if you're looking to build generational wealth, because I believe so much in it. You want to make sure that you use the code generational2020. That is generational 2020. That will give you a $200 discount. If you do the payment plan, it makes the first payment $200 less. So I think that'll be close to like $199 199 or 150 or so, and then the rest of them will be at the regular price. So it makes it very inexpensive to go ahead and hop in now, and then the rest of the payments come 30 days after that and 30 days after that. So make sure you check it out. Thank you guys for coming. Make sure that you share this video. Should have said at the top, I always forget. But again, thank you guys for coming out, and hopefully this came out the right way on Facebook. We've been having some issues, or we had some issues. It worked yesterday. We'll see. All right, so thank y'all for coming out, and I'll talk to y'all later.